All right, welcome everybody. This is a review on how to set up a chart from scratch. Most of the time when you start off with a chart, it's going to be hit or miss. Fortunately for us, most all charting softwares or platforms at this point have decided that candlesticks are indeed valuable. So at least from what I've been able to see, they're either starting off as a bar or a candlestick chart. But that is the first tip that I have for you in building a chart layout. Go with the candlesticks. Okay, you can choose candlestick hollow. You can choose the to see the fill. Because I stream, I have a better chance. I should say a better visibility with the filled candlesticks. When I'm trading on my own, I actually visually, personally prefer looking at the hollow. It makes it easier for me to kind of visualize the impact of the wicks. That's the amount of price that goes to the high and the low on either side of the open and close for a candlestick. But that's a personal preference choice. What matters, though, is you're using the candlestick. And the reason you're using the candlestick is because it gives you the open, the high, the low, and the close for the day. And all of that information has a significant amount of value. As well as, if you have not dug into it yet, we've talked about as a community the value of reading candlesticks. You can see specific patterns set up here on a candlestick chart, as well as potential indications of reversals with pretty relative clarity in comparison to other charting options. So that's why I advocate for candlesticks. That is the first thing that you want to have set up. Your other options, you could have a line chart, which is literally just a line going up and down. You can have a mountain chart, which fills in the negative space at the bottom with some weird gradient for whatever reason. Those look actually pretty good on TV. So you see these on TV a lot. And then you could go with a bar chart, which is basically just an empty candle. You're still getting the open, high, low, close data. I find it personally much harder to read than a candlestick. So, and then you've also got point and figure, but we're not getting into that at all whatsoever. All right, so I've chosen candlesticks as my overlay. The next thing is when you're setting up a study. Okay, the first thing that's important is momentum indicators. The next thing that's important is volume indicators. And then the last thing is an oscillator. I say that everybody should start with at least these three indicators. And as you get comfortable, you might want to add a volatility indication of some sort, or tweak out or swap out one particular study for another. For this video, I'm going to focus on simple moving average, which is not adjusted. It is just simply taking what the average is over the given period of time that you start with. But you can also use exponential, which will put a heavier weighting on the most recent data. Some people like that because it's more reactive and more responsive. Another thing you can do with moving averages is you can change the time frame. So my standard setup, and the reason I use this is because most major institutions are looking at these numbers, is the 10, 20, 50, and 200 day moving average price points. You can speed that up and switch it to a 721. The 20 is a little bit longer, but the 7 is faster, and so slowing down the 20 compensates for that. It is a technique that I used really early on. I know a lot of active traders prefer it because it's giving you indicators sooner. If you swap over to EMA, which is the exponential, and again, it puts more weight on recent data than the overall picture, you could use a 921 or a 721 setup as well. But those are options for you. They're all personal choice. For my example, we're starting with 4 simple moving averages. I'm going to show you how they interact at the end after we've got everything set up, but we're starting those. Next tip, as you're going through, have some sort of color coding idea in mind when you're going through. I personally like short term to be red because that is kind of a warning sign. It's also the same as when the market goes down, it's red. So you tend just psychologically to pay more attention to that color in general when it comes to charting. So my shortest time frame on studies are usually designated or denoted to be red. And then I take the next indicator up and I code that one green because the interaction between the shortest time frame and the next shortest time frame is the first visual thing that you want to be paying attention to when you're looking at charts. charts. And then longer periods of time move to neutral colors. So I put my 50 at yellow and my 200-day moving average at white. And those neutral colors are just something to pay attention to. They're on your chart for a reason, but you don't want to focus on them so much in short-term trading. So that's the thesis behind mine. You should have for yourself as well some reason or some psychology behind why you chose the color scheme you did. There's no right or wrong answer there. Just be consistent, right? Don't put your 10-day moving average on one chart as red, on another chart as yellow, and on yet another chart as blue, because you're going to confuse the hell out of yourself. I don't care how good you think you are. Danger, Will Robinson. So here we go. Red, 10-day, simple, moving average. The next thing is it says show in what panel you want, so you can create a new pane for most studies. Honestly, moving averages need to be correlated to the price. They should always be on the price chart. And then you add other studies or pieces of information in panels below. But we'll get to that as we add more. So here we go. Simple moving average, 20. I go thicker lines so y'all can see it. Yellow, this is 50. Again, thicker line. And 200 is just white. All right, here's another thing. Some people find it visually appealing to have some sort of dash or dot chart. Again, not really helpful. As a matter of fact, I think the more noise you add to your chart, the harder it is to read. So don't go overboard with it. So what does this look like now that we have our moving averages? Pretty straightforward. All right. To me, this is a chart I have been looking at now for 10 plus years, almost exactly, exclusively like this. All right. At first, it is going to feel like a lot more information than what you were just looking at. But I'm going to break down momentum. Realistically, all you're looking to identify is what the price action is doing in relation to any of these lines. Okay. My charting platform allows me to hide and unhide this information pretty quick just by clicking on it up here at the top. Each one's going to be different. Also be careful because I can click the X and close it. I don't want to do that. But here's the chart moving averages. Price above any given line, so above the 10 line, the red one is example, is an indication that according to that moving average, the trend is positive. So now in the 20, still positive. Again, 50, still very positive. But you can see here that the 50 actually held up as medium-term support. We did have some action below, but it recovered quite nicely and has since taken off. That is really all a moving average is helping you do. It is identifying the direction of the trend, pretty clear, pointing up, all right, slightly up here, so not super high, but a little bit to the upside, and that's what you want to see on a longer term, so that's good. It is also acting as a support range for the stock and resistance. So if we go back here in the past, okay, it was support, broke down below, and then it acted as resistance for a small amount of time. Broke above, then it decided to act as support, and then again broke below, and we've got this. All right, this is considered an island because it didn't spend any time interacting with the line, so this wouldn't be support or resistance, but this is very clear support. This is also pretty clear support. So that's all you're using moving averages for, is to identify based on the time frame the overall trend of the stock. If we get rid of the 20 and 50 and we're just looking at the 10, you can see the 10 is a lot more responsive to the stock price. It stays a lot closer. You want it to not be very far away, because the farther away from the 10 moving average it gets, the more the price action has to move to get back to what would be considered a normal pace. Okay, a divergence of price from the moving average is an indication of increased volatility, and you can see that with price actions either up or down. But the 10-day moving average really isn't necessarily a buy-sell signal for swing traders. It shouldn't be, but for day traders, it's useful to identify, has the stock recovered from a recent dip, or is it pulling back from a recent spike? And that should really kind of help you identify whether you're bullish or bearish on a singular day. So there you have it, moving averages. Next important piece of information for a chart, we're going to go back to the studies. We're going to add volume. Okay. Volume is a very strong indication of conviction, and I think that a lot of people discount using it on a regular basis. I can't tell you how many charts I have reviewed over my career, and they just, for some reason, don't want to put volume on their chart. You should have volume. It should be its own pane, meaning it's not overlaid with the stock price. Volume is your indication of conviction. McDonald's volume, right? Indication of conviction. So a red day is a sell-off, right? If you see higher volume on said red day, that means people in general are more pessimistic on the stock. They believe it's going down. So it is either profit taking, or it is a reversal in trend. And you're looking really at the most recent trading area for identification on what that conviction is. So if we're looking at this most recent data, we've got a few green days in here, right? 1, 2, 3, 4. I guess that fifth one kind of counts as green days. But there are more red days. And it is very clear to see on the chart here that the red days hit much higher levels than any of the green days. So to me, that is an indication that currently the market is more prone to sell than it is to buy, and that's how you use volume conviction. You can see a small yellow line here going across the chart. This is the moving average, and that tells you what the average 20-day volume is. You can change that to 10 days. You could also increase that up to 30 or 50 days as a volume to understand what recent conviction looks like. And this is just a guide. Above the average would be considered higher conviction, potentially higher volatility. Below the average is considered quieter, consolidation period, points of uncertainty, or no strong driving conviction one way or the other. So volume's pretty straightforward. I personally like it a lot. Another tip that's not specific to the volume study, but should be paid very close attention to, if you are looking to scalp, as in a quick day trade, or a longer term day trade, so for an hour or so intraday, but your intent is to open and close the same position on the same day, do not try to trade stocks that have less than 10 million share volume. I would also argue that you also try to get a higher dollar volume as well on the stock, because as an example, if you throw $1,000 on a penny stock that's trading at a dime, and it does have that 10 million share volume, but the dollar volume is only equal to, I don't know, 1 million shares or $1 million worth, then you are affecting the market. Just conceptualize it as my $1,000 now only allows for 1,000 total trades throughout the entire day. You are going to be an effect on the market at that point. So check the volume specifically and then multiply out by the price, what the volume is, to understand whether or not you should day trade. That is a tip that's not involved with charting, but it should be taken into account for those of you looking to day trade. All right, so we have volume. The next addition here, we're going to add one more study. I like, as my overbought, oversold indicator, the stochastics, not stochastic RSI, go away. Regular, not RSI, regular stochastic, go up. There it is, stochastic oscillator momentum. Okay, I set personally my stochastics, and the reason I like them is because it's 3 lines, and I use 3 primary lines on my moving averages. So for me, it makes the most sense as an oscillator, and I'm going to show you how to read an oscillator here in a second. But because it has 3 lines, I also color code mine to match up what my expectations are. So shortest term is red, middle term is green, and slowest one is yellow, or the 50 in correlation. Let's make these a little thicker so y'all can see. Boop. And again, we want to make sure that the stochastics ends up in a new pane. All right, I'm not doing any study shifts, but just like the moving averages, if you want to speed this up, you could drop this to a, let's say, a 922 as an example. For a study shift, it will exponentially speed up the data that you have there because it's changing the study balance here. You could also slow it down if you really wanted to. But again, just from myself, All right. For those of you guys who are new, I get it. We want to like have information before everybody else does. We want to put ourselves in a position to have action before other people. But what happens oftentimes, from my own experiences, when you are trying to front run the market, you want to act before the big boys act. Sometimes there's just not enough conviction in a move to push it to the point that's going to force the big guys to act. So I follow the study basics the same way that the big guys do. There will be a fewer smaller prop firms. Okay, I consider them sharks in the grand scheme of things that are going to be out there. They're going to react, and they're going to want to react just as fast, if not faster than you are trying to react. But the big fish, the whales, the biggest money, tend to have more of a sit back and wait approach. And rightfully so, because if they were to try to react to every move in the market, then they're only making things harder on themselves, because to get in and out of the market with significant volume takes a lot of money, and you do start to kind of affect prices that way. So it is not in everybody's best interest to active trade, and that's why I stick to the standard studies, because I care more about what the long-term trends are than just the short hyper-minute trends, because I can still get action and I can still identify opportunity just as quick as everybody who's speeding up their studies, right? But what tends to happen is people speed up the studies, they get the buy or the sell signal, they take action, and then it just doesn't follow through. So I wait for the follow through, because barracudas, you and I, retail traders, we are small money in comparison. We are just trying to pick up the leftovers from the sharks and the whales. You are not causing a move in the market. You don't have enough money. So trying to jump ahead and be first to action tends to be more costly from my perspective and experience. I've got 19 years, so take it or leave it for whatever you will. But it tends to create more headache, more heartache than it does actual wins. And you just kind of have to figure that out for yourself as you trade. Chem life will cause moves someday. Hey, if anybody's going to be causing moves in the market, I think you've got the tenacity to make that happen. All right, so stochastics on the pane here. This is an oscillator. Again, just like the moving average, shorter term, so this is the fastest responding line, is red to identify when I should take action. The slightly slower, and you can see this is smoothed out in comparison to the red. It still follows, it still moves accurately, just not as sharp and not as frequent, jittery, is the green. And then finally the slow, okay, even smoother than the green. Right, so a lot smoother of a line, slower reaction. I personally react to the D slow on stochastics for my overbought, oversold indicator. All an oscillator is doing, okay, is moving above overbought territory and below oversold territory. Okay, and your action points for reading this particular study are when it crosses from below to overbought territory. Right now, we have higher volatility. So this would be a buy signal for you, okay, if you're reacting to the market. The next thing you're looking for is when it dips from overbought down to neutral territory. So anything in between the top line and the bottom line, and your oscillator is going to have different levels. For the stochastics, it's 75 and 20. For others, it's 70-30 or 80-20. So different levels, but my stochastics are 75-25. Overbought 75, oversold 25 indicators. Anything in the middle of those two lines is really not an actual signal. It just means that the market is undecided. It's in transition, either to go back up maybe to overbought territory or maybe down into oversold. So anyways, buy signal here. I would also indicate that this dip below oversold now is a sell indicator. So I would have been out. Okay. Price action here, oversold. If I thought the momentum was going to hold, I would consider that a short sale. And then moving back into neutral here. So this would have actually been a loss trade, small loss, because it didn't keep going down. But you get out before a major spike. Very next day, right there, bam, overbought territory. So you buy here, you ride up until it's time to sell, which is here. All right, that is an oscillator, and this is probably one of the easier signals to identify clear buy sell points or marks on a chart after watching for a little while. So I like this in combination, but remember, you're also wanting to understand what the overall momentum is, which is why you have the moving averages. You also want to know what conviction looks like, which is why it's important to look at volume. So you take all of these in combination to each other. My rule of thumb is 3 indicators for a buy, okay? Confirmations. So I've got a moving average cross to the positive. Volume conviction looks to be picking up. I know that this was a big sell day, but we're pretending we didn't see that day yet. And then stochastics moving into strong territory. With that, 1 buy, 2 buy, 3 buys, I would have bought. 2 indicators for a sell because I'm risk adverse. You're going to have to massage that for your own trading strategies, but 2 indicators for a sell. So 1 sell indicator here. This was 1, 2 sell for the volume. That would have been okay. Price action right here dipping below the 20 may have been enough to convince me to sell, but moving average 10-20 didn't actually cross. So realistically, that would have been a sell, but nothing happened. Here though, moving average would have crossed below. Sell signal here on volume, very clear sell signal here on the stochastics. So I would have sold here for that trade pretty clearly. But that's how you set up a chart, and that's how you use multiple studies in tandem to each other. So hopefully seeing how somebody who's done this for a long time and coached a great many traders helps you understand better what you need to set up on your charts. Remember, there are tons of studies out there, okay? The overall guide is, if you get beyond 3 studies, you're overdoing it. You really, really are. Okay? You can make a case for sometimes 4 or 5 studies. I'm not going to hate you for it. But if you pass 5 studies, you're going to end up with paralysis by analysis, meaning you've got way too much information coming in to make actionable data or decisions off of. All right, that is the whole point of data analysis, is to have actionable information. What we're going to do now is we're going to go ahead and add multiple time frames for your chart. I set everything up on the daily, and at the beginning of the explanation, I kind of mentioned to you guys that it was important to understand when you set up your chart, you pay attention to the same pieces of information regardless of time frame you're looking at. In my platform, it's easy to duplicate. So I'm just going to duplicate the chart multiple times. Duplicate. Duplicate. 1 daily, weekly, monthly, intraday, 1 minute, intraday, 5 minute. So with the shortest amount of time here on the left, we're going to the 1 minute chart. Okay, this is displaying all of the same studies, but now instead of daily candles, we are looking at 1 minute candles. So I have the 1 minute set up. I'm going to switch this to 5 minute. You should be in a position to be able to review both in your charting platform. Not all 1 minute setups are confirmed or likely to follow through. So the reason for the 5 minute is so that you can verify a setup on your 1 minute and make sure that that setup is in line with the current trend for the daily volume. Some people find it helpful to look at a 15-minute chart as well. I personally only review the 15-minute charts if I'm getting questions. Otherwise, I don't find it super useful in terms of trend analysis. If you are trading different vehicles like cryptocurrencies or futures, you will find 1 hour candles are actually pretty valuable. So you may want to consider that for those instances. What you see here is a difference in shading. The left side is pre-market and extended hours trading from the previous day, and then the darker section is just your normal intraday data. Next is the daily. This is what we set up, so you should be well aware of that. And then what I'm adding here is a weekly. For most folks, the weekly chart is plenty of information. I personally tend to be more fundamental analysis and longer term swings, so I also like to verify momentum on the monthly chart. The monthly is kind of a take it or leave it. It is important though, if you are swing trading, to understand the overall momentum on a weekly basis before choosing your entry and exit points just based on the daily information. Long story short, or I should say the easiest way to highlight why that information is important is if you were bearish here, right here in this section, okay, and you thought, oh, the market's going down, you should have been looking at the trend on the weekly to kind of give you a little bit better semblance of the reality of the situation. Yes, weekly was declining, but there was no activity below the 20-day, I should say 20-week now, moving average to indicate that a sell-off was warranted. So if you had taken short positions here, you can see that the market very quickly proved you wrong. So don't buck the trend is the primary reason, and the same way that I just provided the analysis for the weekly versus the daily, you would then use the daily momentum to identify what your overall sentiment should be on an intraday chart. So that wraps it up for chart reviews. Thank you, everybody, for participating. This is Brian with Where Rebels Are. We stream on Twitch 4 days a week, starting at 1 p.m. Eastern and going through till about 4 or 5 p.m. Monday, Tuesday, Thursday, and Friday. Come join us. We'd love to have you.